Don?
Thank you, Lisa, and thank you to all of you for joining us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's presentation, and we are also interested in hearing from you about any suggestions or specific topics that you would like us to consider for future webcasts. For your reference, our contact information is provided at the end of this presentation. It is worth noting that the source of all the data today is from the AFS Pricing Dashboard. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. In addition, the AFS Pricing Dashboard is also used to prepare our monthly Pricing Trends newsletter. If anyone is interested in learning more about our pricing dashboard, or if you're interested in receiving our monthly newsletter, you can reach out to us. Again, our contact information is provided at the end of this presentation. As a baseline for our analysis, we highlight the key findings in 2Q here on slide 4. Starting with balance growth, the pace of total balance growth cooled considerably in 2Q. There is more than one possible explanation for the recent slowdown in loan growth. Many potential borrowers are still flush with capital thanks to the tax cuts. Trade tensions and the threat of escalating tariffs may also have impacted business borrowing as of late. There is one segment of the market where we continue to see loan balances increase at an accelerated pace. That is the finance and insurance industry. Lending to non-banks continues to grow, reflecting a trend of credit disintermediation in the marketplace. Consistent with prior years, aggregate new renewed volume increased in 2Q from the prior quarter. However, 2Q volume was down when compared to the level seen in the same period a year ago. In terms of pricing, the general trend we are seeing, especially in the middle market space, is that spreads on floating rate loans continue to narrow. This trend is especially evident when viewed over a long time horizon. Compounding the pricing challenge is the fact that the yield curve for commercial loans has flattened considerably year over year. For new loans, fees were a bright spot in June. Fee incidents and levels increased month over month for new bilateral loans. However, these same metrics were down this month for bilateral renewals. We mentioned trade tariffs as an important economic driver of the trends we're seeing. In today's special topic, Jeremy Charlson will take a closer look at the U.S.-China trade war and its impact on commercial lending. Moving to slide 5, we look at the current environments banks are operating in today. While our economy is quite good at the moment, it is giving off some mixed signals. GDP growth and unemployment remain sound, both of which are highly linked with commercial loan growth and performance. On the other hand, the yield curve remains inverted. There are different views on how seriously we should take this, but the facts are, on average, 12 months after the yield curve inverts, we have a recession. This inversion also has unfavorable implications for a bank's net interest margin. The other challenge banks have is that loan spreads remain flat despite rising rates. The Fed has raised rates several times already, and average interest rates, for the most part, have followed. But spreads have not, and this has limited the margin increases that the banks typically enjoy. On slide 6, we get a more precise illustration of the spread compression taking shape in the market. Here we are focused on bilateral loans under $5 million in size. Starting on the left, we can see that weighted average interest rates for LIBOR and prime-based loans have increased over the last year. Yet despite these rate increases, spreads on LIBOR and prime loans have actually narrowed over the same time period. The chart on the right shows that the average spread on LIBOR loans fell 16 basis points, while prime spreads fell by as much as 18 basis points. Spread compression, coupled with an inverted yield curve, means that bank net interest margins are under pressure and probably will remain so for the near future. From a profitability standpoint, two of the most important drivers for bank margins are the risk curve and the term curve. On slide 7, the chart on the left illustrates the relationship between weighted average interest rates and risk ratings. For this chart, we mapped each bank's internal obligor risk rating schema to the RMA 10-point scale in order to present a standardized look at loan pricing. As you would expect, pricing increases along with credit risk. More importantly, when compared to the same quarter a year ago, the contour of the risk curve was little changed in 2Q19. The takeaway is that banks are not loosening standards when it comes to pricing for credit risk. It's a different story for the chart on the right. Although not dramatically, a year ago, the term curve sloped upward. A year later, in 2Q19, we observed little relationship between the weighted average interest rates and term length. The recent inversion in the Treasury yield curve is contributing to this dynamic, resulting in longer duration loans not offering the same premium they once did. With balance growth having slowed in the second quarter, we thought it would be interesting to examine this trend within a historical context. The chart on slide 8 examines year-over-year C&I loan growth each month relative to a long-term historical average. So over the last 20 years or so, annual loan growth has averaged about 4.7%. When the blue line on this chart trends above the horizontal axis, that means loan growth in the given month outpaced the historical average. A few noteworthy observations. Total C&I loan balances increased 6.7% year over year in June, which is the slowest pace of any month this year, but still above the long-term historical average. So while total loan growth is decelerating, there is still enough business loan demand out there to keep the trend above the historical average. There are a number of different financial, economic, and regulatory events that have contributed to this growth pattern. For example, we saw loan growth begin to slow around the time that low oil prices hindered growth in energy lending. And as recently as 2017, we saw C&I loan growth fall beneath the historical average. Around this time, many companies were flush with cash from the tax cuts, which translated into weaker loan demand. The backdrop of slowing balance growth and declining spreads paints a negative picture for the second quarter earnings season. On slide 9, a recent article summarizes these conditions, arguing that a flatter yield curve and the prospect of a Fed rate cut could pressure bank margins even further. And without higher loan volume to mitigate these trends, there are a few other catalysts for revenue growth. A contrarian view is that these concerns are overblown. If the Fed does cut rates, as they did yesterday, then this could spur economic growth and actually lead to a steeper yield curve. One thing is for certain, given these market realities, pinpointing the areas where loan growth and pricing are still robust is more important than ever. Many of the upcoming slides today will illustrate where these areas of opportunity exist. So let's see how the market dynamics are playing out in 2Q19. Starting with the top left chart on slide 10, we can see that the pace of total balance growth continued to slow in the second quarter. More specifically, June was the slowest month for total commercial loan growth in 2019. Trends in new renewed volume provided one explanation for June's sluggish balance growth. As illustrated by the top right chart, aggregate new renewed volume increased only slightly in June from the prior month. Spreads on new and renewed loans declined month over month, as shown by the bottom left chart. When compared to last June, spread pricing for both new and renewed loans was up. And we can see that as of June, total annualized fees were very similar to the same period a year ago. On slide 11, we take a closer look at balance growth trends. An interesting component of the loan growth story this quarter is the divergence between bilateral loans and participations. Starting with the top chart, the pace of bilateral loan growth, shown as the blue line, accelerated in 2Q19. The increase in bilateral loans was tempered by a sharp drop in participations. Participation balances in 2Q were down 1.3%, the second largest quarter-over-quarter decline in our database. We were not able to attribute this decline to any one factor, as the decrease spanned multiple industries and geographic regions. At the bottom of this slide, we dig deeper into the trends and examine variations in year-to-date balance growth across various loan size ranges. The bottom left chart is focused on bilateral loans. This picture for bilateral loans is one that we've seen many times before. Larger loans, those over $5 million in size, are growing, while lending to smaller end borrowers is down. Part of this divergence is due to increased competition from non-bank and fintech lenders, which continue to gain market share in small business and business banking space. For participations on the right, balances were up year-to-date across every loan size segment except the greater than $25 million range. Growth in smaller, what some refer to as club deal participations, is a trend we've been tracking over the last several quarters. For banks that don't have the size or scale to diversify easily into new regions or industries, participations represent a diversification vehicle to access high opportunity markets. So how can banks leverage this information to gain a competitive advantage? In terms of improving bank performance, there are two types of critical success factors. The first group relates to internal operational and policy considerations. Turnaround times, approval times, robust product offerings, and holding RMs accountable for pricing and fee performance are the types of things banks can focus on internally. The other perspective banks can take is to look externally at trends in the marketplace. This is where benchmarking data from the AFS pricing dashboard helps to enable a bank's growth strategy. The banks who best incorporate market data into their strategic view generally focus on the three pillars shown here. The first pillar focuses on growth. Each month, we look to see which regions are leading the growth in new originations and how loan growth varies by line of business, industry sector, etc. In an environment where net interest margins are under pressure, it is critical for banks to optimize their commercial loan portfolios. Market data can reveal the industry sectors that consistently outperform in terms of risk and return, allowing banks to focus on these high opportunity areas. Finally, while market data can shed light into the best industries and best regions, it is just as important to know which areas of the market are at risk of overheating. For example, a couple of quarters ago, we noticed that pricing was falling and risk was rising in Tampa, Florida, an indication of intensifying competition in that particular market. With these themes as a backdrop, we move to the next slide, where we will focus on specific geographic and industry drivers of balance growth. We start with a look at the state profile. You can think of this as the regional winners and losers. The top 5 and bottom 5 states are reported. It is important to mention here that the geographic data presented in this webcast is based on the location of the borrower, not necessarily the location of the bank booking the loan. The chart at the top of slide 13 presents a state view for all loan types and reports the year-to-date balance growth through June 2019. These charts are based on the change in outstanding dollars to determine the top 5 and bottom 5 states, and then presented ranked by the percentage change. Illinois reported the largest growth in total balances during the first 6 months of the year, up 6.4%. Higher balances in 2 subsectors contributed to this growth: transportation equipment manufacturing and the merchant wholesalers durable goods subsector within wholesale trade. We also see Texas up 3.5%. The telecommunications subsector and the oil and gas extraction subsector were responsible for the higher balances in Texas. In the bottom left chart, there is a breakout for bilateral loans. California and Illinois saw balances more than double the national average. The bilateral balance growth for California of 5.4% was concentrated in the telecommunications and finances, credit intermediation, and related services subsector. The balance growth for Illinois, also at 5.4%, was again concentrated in the merchant wholesaler durable goods subsector within wholesale trade. For participations in the bottom right, we see Illinois as the second-ranked state with an increase of 8%. The growth here is also concentrated in the transportation equipment manufacturing subsector. Virginia, the number one state, saw a large increase in the computer systems design and related services subsector, as well as machinery manufacturing and transportation equipment manufacturing. On the next two slides, we look not only at the top 5 and bottom 5 states, but the entire country. On slide 14, we present a heat map for the balance growth across the country. The colors on this map indicate the level of dollar balance growth experienced by a particular state, with dark green indicating the highest level of growth and red representing a decline. The map on this slide focuses on bilateral loans, and we can see that balances were up across most states at the end of June. As we saw last quarter, balances are down in most of the states in the Ohio River Valley. The map presented on slide 15 changes our focus to the balance growth for participations. Participation balances were up year-to-date across most states. Illinois is the only state to appear in the top 5 states for both bilateral loans and participations. And as we just saw on the previous slide for bilateral loans, Tennessee and Kentucky are also in the bottom 5 states for participations. As the last few slides have demonstrated, there are clearly a handful of geographic markets that have generated balance growth well above the national average. On slide 16, we present a more concise picture of this dynamic. Here we identify and aggregate the top 10 CBSAs based on their contribution to total U.S. real GDP. Our thinking is that a region's level of economic activity is related to its potential for future loan growth. The top 10 CBSAs are illustrated in aggregate by the dark blue bars, whereas the lighter shaded bars represent all other geographic markets. Since March 2016, the pace of total balance growth for the top 10 CBSAs has accelerated during every quarter, far outpacing the growth rate for all other geographic regions. You can see on the far right that while total loan balances for the top 10 CBSAs has continued to grow, climbing higher by 1.3% in the second quarter to 18%, the remaining markets have been well below this pace, hovering around a 2% growth rate through the third quarter of last year. We do see that balances have recently jumped up in the other regions, as of 2Q19, up 5.8%, but that is still much lower than the 18% rate for the top 10 CBSAs. The implication here is that as business borrowing picks up, the top 10 CBSAs have continued to experience significant increases in total loan balances, and the AFS pricing dashboard has the data to help you find where the opportunities exist in today's improving markets. As we just saw on the preceding slide, you can examine trends within states. Our pricing dashboard is configured to drill down beyond the state level and view trends for specific core-based statistical areas, or CBSAs. For example, we just saw California in the top 5 states for bilateral loan growth. On slide 17, we can see that the year-to-date growth of 5.4% for bilateral loans in California exceeded the national average of 2.3%. And San Francisco and Los Angeles contributed to that higher than average growth rate. Riverside and San Diego also posted positive growth rates. However, San Jose actually lost ground during the first 6 months of 2019, down almost 3%. This geographic precision allows us to distinguish the winners and losers very quickly and is the type of data you can leverage to be very competitive in your own markets. As we move to slide 18, we continue our focus on balance growth and highlight the best and worst performing industries. The mining, oil, and gas sector is ranked highest for total balance growth for the first 6 months of the year, with the largest growth seen in Texas, specifically in Midland, Dallas, and Houston. Moving down to the bottom two charts, we can see that two sectors, manufacturing of wood and chemical products and finance and insurance, ranked among the top 5 fastest growing industries for both bilateral loans and participations. Both sectors are significantly higher than the all-industry average through the first 6 months of the year. The chart on the left shows bilateral loan growth, and information is the top industry, especially in cities like Los Angeles, Dallas, and St. Louis. Honing in on participation growth, we see that the retail trade sector focused on motor vehicles, electronics, and building materials is ranked highest, with growth seen in Harrisburg, Pennsylvania, and Knoxville, Tennessee. Ranked second is the accommodation and food services sector, where we saw significant growth in Miami and Las Vegas. On the next two slides, we again look across the entire country and present the industry with the largest year-to-date growth in each state. On slide 19, we focus on bilateral loans. For example, as mentioned earlier today, California had the largest increase in the finance and insurance sector, which is shaded dark blue, and Illinois, with the largest increase in wholesale trade, is shaded green. The map presented on slide 20 changes our focus to the balance growth for participations. As with the preceding slide, the industry with the largest year-to-date growth in each state is presented. We can see that several states are shaded light blue, which means that the manufacturing sector has experienced the largest growth in outstandings in these states as of the end of the second quarter. A few slides ago, we saw the granularity that the AFS pricing dashboard provides users when looking at trends across the country, with insight down to a CBSA level. Our pricing dashboard also lets you examine trends within industries. Industry trends can be analyzed all the way down to a 6-digit NAICS code. On slide 21, we see that within the information sector, the telecommunications subsector had a positive impact on loan growth in 2019. Drilling further down to the 6-digit NAICS level, we see that telecommunication resellers and wired telecommunication carriers were responsible for the growth seen this year, while balances for wireless telecommunication carriers decreased 6% this year. Having this granularity is what the AFS pricing dashboard provides, and something for you to consider when you need very detailed data to support your own pricing decisions. In addition to examining trends in total balances, the AFS pricing dashboard enables users to analyze trends for new and renewed loans in order to gain valuable insights into the impact of the most recent lending activity. On slide 22, we begin with a look at new and renewed bilateral loans. Starting on the left, we can see that June's new loan volume and renewal volume is lower than last June. Lower new and renewed volumes within the wholesale trade sector and the healthcare sector more than offset higher balances in the information sector and in the manufacturing sector focused on metals, machinery, and electronic products. Compared to last month, we saw an upswing for both new and renewed bilateral loans. Higher balances in the finance and insurance sector bolstered June's new and renewed volume. Moving to the chart on the right, we focus on the pricing of the most recent lending activity. The LIBOR equivalent spreads as of June for new loans are slightly lower than June of last year, down 4 basis points, while spreads on renewed loans were unchanged. When compared to the previous month, the weighted average LIBOR equivalent spread for new loans went down 17 basis points to 187 basis points. For renewals, the average spread of 201 basis points is down 2 basis points from the previous month. And for your reference, the 10-year Treasury rate is also provided. The 10-year Treasury at the end of June was 207 basis points, which is 33 basis points lower than last month. To help demonstrate the competitive landscape that persists in commercial lending, slide 23 looks at the drivers of commercial loan pricing. Two of the most important determinants we see are risk rating and deal size. The charts here show the long-term trends in pricing for bilateral loans by focusing on LIBOR equivalent spreads. The chart on the left looks at spreads across risk. The dotted black line depicts the market average, and we can see the steady decline in spread pricing over the last several years. We know that over this time period, many banks have adjusted their loan mix to focus on better rated credits. However, the overall spread compression is reflected across all risk brackets, not just the best rated loans. In fact, the low pass segment displayed the largest average quarter-by-quarter compression seen over this time frame. A similar picture is presented by loan size on the right. From a loan size perspective, spread compression was evident across all segments. The smallest loans, the red line representing deals under $1 million, experienced a rebound in spread pricing as of late. But when viewed over the long term, this segment, as well as the other segments, have seen spreads fall significantly over time. Next, we will quickly look at the volume and pricing trends for participations. On slide 24, the chart on the left shows that total new and renewed volumes for June are down when compared to both June of last year and to last month. The accommodation and food services sector contributed to lower new and renewed volumes in June. We also saw that the finance and insurance sector had the largest decrease in new volume. Looking at the chart on the right, an inverse relationship is seen for new loans and renewals when compared to the same period a year ago. With loan volumes down, the weighted average LIBOR equivalent spread for new loans is up 24 basis points, and the average spread for renewals increased 28 basis points. When compared to the prior month, a negative correlation is seen for new loans, and there is a positive correlation for renewals. Again, with loan volumes down, the weighted average LIBOR equivalent spread for new loans is up 7 basis points, while the average spread for renewals fell 11 basis points. Next, we will look at the final layer of our market review. Slide 25 focuses on commercial loan fee performance. Fee revenue is a vital part of an overall bank profitability strategy, and this slide provides insight on A, how frequently upfront fees are assessed, shown here as the fee incidence, and B, the total amount of fees assessed, or the fee level. The chart at the top left of this slide shows that on a year-over-year basis, the fee incidence rate is down for new bilateral loans and was up slightly for renewals. On the top right, we can see that the fee level for new loans edged higher in June, rising slightly above the level seen a year ago, while the level for renewals was below the level reported a year earlier. As we saw with the loan volume and spread pricing, the AFS pricing dashboard enables users to examine the industry drivers of fee performance. Consistent with the prior year, healthcare was the highest industry in terms of upfront fee incidence, as shown on the bottom left chart. The bottom right chart shows that mining and transportation displayed the largest year-over-year increase in upfront fee level. And now we will transition into our special topic for today. Jeremy Charlson will provide a look into the lending involving tariff-sensitive industries. Jeremy?
Great. Thank you, Don. So probably the thing that stood out to me the most looking at the 2Q results was the slowing in commercial loan growth. Now, as Don mentioned, there are a number of different theories for what's behind that trend, but one factor that potentially weighed on business borrowing this quarter was the trade war between the U.S. and China. Trade tensions and the threat of new tariffs create a general sense of economic uncertainty, and uncertainty is probably the one key factor that most impedes loan growth. For example, firms that source goods abroad, especially firms that source goods from China, may be holding off on any major business or expansion plans right now. So for this quarter, our special topic will examine the trade war between the U.S. and China in the context of commercial lending. When you consider that the tariffs currently cover over 6,000 different items, it's a huge list, there are very few industries that are not affected in some way. However, our intention today is not to cover each and every product, but rather we've examined all the affected goods and created a few groupings that are made up what we call the more tariff-sensitive industries. So once we've identified that group of tariff-sensitive industries, we can then examine how material they are in terms of loan volume and where they tend to be concentrated from a geographic perspective. It's our hypothesis going into this analysis that the tariff-sensitive industries are the sectors most responsible for 2Q's sluggish loan growth. In other words, we assume that the companies most affected by the tariffs are the ones that have limited their borrowing as of late. So let's see how that plays out. What we have here on slide 28, we have, to help set the stage, a timeline of all the key events related to the trade war. So on this graphic, the light blue boxes denote U.S. imposed tariffs on Chinese imports, whereas the dark blue boxes describe Chinese tariffs on American-made goods. And I really like this graphic because it helps show the tit-for-tat nature of the developing trade war between the two nations. Officially, the trade war began on January 22nd, 2018, when President Trump announced tariffs on washing machines and a few other goods. What followed was a series of escalating and retaliatory measures between the two countries, ultimately culminating in multiple tariffs covering over 6,000 different items. And I think that list has actually grown a little bit since that time. By the year end of 2018, the U.S. had imposed 10% tariffs on $200 billion worth of Chinese goods. Now, there was a deal reached between President Trump and his Chinese counterpart at the G20 meeting in December, which had delayed a planned increase in the tariff rate from 10% to 25%. However, this year in 2019, talks between the two nations fell apart, and the tariff rate imposed on Chinese goods jumped to 25%. In response, China hiked duties to 25% on $60 billion of U.S. goods. Now, documenting this series of events is more than just a historical exercise. With so much uncertainty surrounding how and when these tensions will be resolved, there's bound to be some impact on business investment and borrowing. I think it's especially noteworthy that the chairman of the Fed also referenced trade tensions as one reason for, probably the predominant reason, for why we had a Fed rate cut yesterday. Now, the economic forces driving the trade war began long before President Trump took office. The chart here depicts the volume of U.S. imports by major trading partner. And since the year 2000, U.S. volume of Chinese imports have increased fivefold. Chinese imports make up a much larger share of total U.S. imports than the other major trading partners shown here, including Canada and Mexico. So given the magnitude of the trade between the U.S. and China, the tariffs are likely to have some bite on economic growth. And while tariffs have been placed by the U.S. on other nations, and there's even a threat, I think, to place some tariffs on some Mexican-made goods, the dispute with China appears to have the largest ramifications given the sheer size of our economic relationship with that country. So for our purposes today, we'll focus predominantly on the goods and industries impacted by the tariffs levied on Chinese goods. An argument can be made that some sectors of the economy are more insulated from the tariffs than others. And in terms of putting some parameters around the analysis, this chart created by JP Morgan helps illustrate where the products covered by the tariffs are most heavily concentrated. As I mentioned before, the list of goods impacted by the tariffs covers over 6,000 different items. I was looking at the list today, and some of these items, honestly, I've never even heard of, but it's a very comprehensive, very large list. And if we were to group the products into broad industry groupings, again, to get some basic sense for where they're concentrated, there are two sectors that stand out in particular, those being industrials and technology. So looking at the far left of this chart, we can see that of all the goods impacted by the tariffs, imports from China make up approximately 4.5% of the total volume in the industrial subgroup. And while on first blush that number doesn't seem too high, that's a pretty large concentration for an individual country. In terms of composition, the industrial subgroup represents capital-intensive industries, ranging from heavy construction to transportation to support services and machinery manufacturing. If you think back to the first set of tariffs placed on washing machines, those types of goods would generally fall under the industrials heading. We see a concentration of similar magnitude for the next subgroup, technology. The technology subgroup is focused on electrical and computer components. So companies in this subgroup include tech distributors, electrical component manufacturers, software publishers, and data processors, really the whole spectrum of the technology sector. For our analytical purposes, we will say that the industrials and the technology subgroups represent what we call the most tariff-sensitive industries. The materials subgroup, shown third from the left on this chart, represents certain commodities covered by the tariffs, including steel, aluminum, chemicals, and wood paper products. Interestingly, Chinese imports in the materials subgroup represent a much smaller share of the total import volume than seen for the preceding two sectors. That said, we thought it would be interesting to examine loan growth and pricing for this industry, since the sector has generally shown a pretty high degree of volatility in the equities market. So let's see how material these tariff-sensitive industries are in terms of commercial loan volume. As a group, the tariff-sensitive industries comprise approximately 14% of the total C&I and CRE outstanding balances in the pricing dashboard database. And as with most types of industry analyses we perform, we observed a very wide range in terms of concentration across the banks. Bank A reports as much as 21% of its total outstandings focused in the tariff-sensitive industries, whereas Bank S on the opposite end had only a modest fraction of exposure in these same sectors. For more than half of the benchmarking banks, the tariff-sensitive industries represented at least 10% of total wholesale exposure. For every bank, the industrial segment, the blue series on this chart, was the largest subgroup in terms of loan outstanding balances. Note that materials, the red portion, does not include oil and gas. Furthermore, the materials segment is very volatile in terms of non-performing loans. If you go back in time, it had a very sharp deterioration during the last recession. So it's not surprising to see that many banks have shied away from this particular segment. In terms of why the green slice of the bar, the technology subgroup, doesn't comprise a greater share of the total, an educated guess is that many companies in this segment have access to capital markets and other sources of funding besides commercial banks. From a geographic perspective, the tariff-sensitive industries are well diversified across the regions. From this perspective, the Middle Atlantic displayed the highest percentage of commercial loan balances concentrated in the tariff-sensitive industries, followed by the Eastern Midwest region. And mirroring what we saw for the bank profiles, the industrial subgroup comprised the largest share of outstandings within each geographic region. The Southwest was the max for the technology category, again, the green series on this view. Now, you may wonder why the Southwest doesn't show a higher concentration in materials, the red slice. The reason is that this segment does not include oil and gas, but rather is more generally focused on steel, aluminum, and forest products. For materials and related industries, it was the Eastern Midwest, not the Southwest, that was the largest region in our database. But the key takeaway here is that should the trade war begin to hinder economic growth, then all geographic regions will experience the negative side effects to some degree. A more granular look at the geographic dispersion is presented here on slide 33, this time by state. On this map, darker shades of yellow indicate larger concentrations in the tariff-sensitive industries. An interesting observation here is that all but a handful of states reported at least 10% of their total commercial balances focused in some combination of these tariff-sensitive industries. So again, the point is that from a loan balance standpoint, the trade war and the impact on the tariff-sensitive industries have many important ramifications for most areas of the country. So going back to our original hypothesis that the tariff-sensitive industries were a drag on loan growth, let's see if recent loan growth trends reflect that assumption. The line chart here illustrates growth in total balances, where growth in each month is compared to a December 2015 baseline. So you can think of this picture as a cumulative change in commercial loan balances over the period. Let's focus first on that dotted black line, which is the market average. Relative to our base period, balance growth for overall commercial loans has plateaued in recent months. The tariff-sensitive industries certainly played their part in this slowdown. The total group of tariff-sensitive industries is shown by that dark gray line, which you can see has trended downwards in recent months. So in many ways, that group of industries has dragged down the market trend for total balance growth. However, the loan growth story is far from uniform when we look across the subsectors within this group. Industrials, the blue line, and the largest category of tariff-sensitive industries, is dragging down the overall trend. The industrial segment includes washing machines and industrial machinery manufacturing, so many things covered by the first round of tariffs. For all of 2018, the trend line for industrials was in negative territory, with a very short-lived rebound in 2019. By comparison, the technology and materials categories, the green and red lines respectively, experience much higher levels of loan growth. And while the trend lines for these two segments are both very volatile, the technology and materials subgroups experienced higher growth in the market during nearly every month illustrated on this chart. If we look at the right-hand bar chart, we can see that from December 15 to the current month, both technology and materials enjoyed levels of loan growth well north of 10%. Over the same period, the industrial segment managed to gain only 1%. So taking this all in, I think our original hypothesis needs to be modified. The industrial segment has certainly weighed down loan growth as of late. However, the other two tariff-sensitive groupings continue to enjoy loan growth rates well above the market average. For many businesses, the tariffs have the potential to disrupt supply chains, raise costs, and reduce free cash flow. Consequently, for firms and industries deemed tariff-sensitive, the tariffs represent a potential increase in their credit risk profiles. In this light, you might initially think that the tariff-sensitive industries would display higher pricing to match this added risk, but that's not what the data shows. Let's start on the left-hand side of this picture. For all industries, that is the commercial loan market as a whole, the weighted average LIBOR equivalent spread for new renewed loans was up slightly in 2Q when compared to the year earlier period. Conversely, spread pricing for the tariff-sensitive industries was down year over year, falling beneath the market average in the latest quarter. Once again, we see a stark contrast in trends between the industrial segment and the other two tariff-sensitive categories. Spread pricing for the industrial segment, while down over the last year, did remain above the market average, not by much, but by a few basis points. Instead, it was the technology and materials categories, the two segments on the right, that are dragging down spread pricing for the tariff-sensitive industry group. This was a bit puzzling to us, particularly the low spread for the very volatile materials segment. When we examined the borrowers within the materials subgroup, we had observed a very low spread pricing for what you might call specialized firms, such as those focused on specific types of electrical and appliance manufacturing. So in terms of the credit risk for the tariff-sensitive industries, what kind of outlooks do banks in the pricing dashboard have for these sectors? On this slide, we graph weighted average expected loss estimates for the tariff-sensitive industries. Expected loss projections for the entire group of tariff-sensitive industries were up in 2Q19 from the year-ago period, increasing by a much sharper degree than seen for the market average. What's interesting here is that the increase in expected losses for the tariff-sensitive industries was not driven by the industrial segment, the one where we'd observed loan balances declining at a pretty fast pace. Rather, it was the technology and the materials segments that experienced the most significant increases in credit risk over the last year. Now, thankfully, the increases in expected losses were relatively contained within both groupings. For technology, we observed risk rating downgrades for software publishers. It wasn't spread out across too many other subsectors outside of that. And for materials, it was the chemical manufacturing subsector that drove the year-over-year increase in expected losses. One of the ways that we like to present the data is with pricing and risk collapsed into the same view. This allows us to see whether pricing is commensurate with risk across various subsectors within the marketplace. On this graph, the blue dots are LIBOR equivalent spreads, whereas the red dots depict expected loss estimates. The line graph formed between the two dots is what we call the risk-return margin. So you can think of that vertical line as a type of risk-adjusted spread. It's a pricing measure compared to a risk measure. So take a look at the first two line charts, the ones corresponding to all industries and the group of tariff-sensitive industries. What these pictures tell us is that spread pricing is lower and credit risk is higher for the tariff-sensitive industries versus the market average. The result is a comparatively more narrow risk-return margin for the tariff-sensitive industries. The same can be said to varying degrees for all three subgroups. Industrials, technology, and materials all exhibit more narrow or weaker risk-return margins than the market average. The margin is only slightly lower than average for the industrial segment, the largest tariff-sensitive industry category, and the one weighing down commercial loan growth as of late. Of the three subgroups, it was technology that displayed the lowest risk-return margin. More specifically, technology not only displays the lowest spread pricing, it also displays the highest expected loss estimates, which resulted in a very compressed margin in the period for this particular subgroup. So in summary, the industries identified as being tariff-sensitive are material exposures for nearly every bank in the database and are well diversified from a regional perspective. So if the tariff or the trade war does take a bite out of economic growth, that adverse effect will be felt across a wide variety of banks and geographic regions. Now, before this analysis, it was our hypothesis that the tariff-sensitive industries were responsible, at least in part, for the recent slowdown in commercial lending. For the industrials category within this group, that certainly was the case. But for technology and materials, loan growth was actually very robust, so the loan growth trends were certainly not uniform across all of the tariff-sensitive industries. On a year-over-year basis, expected loss projections have increased across all three tariff industry subsectors, perhaps reflecting the uncertainty and hesitancy brought on by the trade war. And when viewed in the context of spread pricing, risk return was weaker than average for the tariff-sensitive industries. So time will tell just how large of an impact, if any, the tariffs will have on commercial lending. There is one leading economist that even speculated that, in terms of the overall economic impact, the trade war is much ado about nothing. He believes that should tariffs start to have any sustained negative impact on the stock market or the economy, the U.S. government would cut a deal and put an end to this particular dispute. So looking ahead, we'll continue to monitor these tariff-sensitive industries and provide updates on how the broader market forces are impacting their risk and return profiles. And for your reference, we've included in the appendix of this presentation the NAICS mappings of the tariff-sensitive industry groupings. So that concludes our 2Q19 commercial loan pricing webcast. Many of the ideas that you saw here today were designed with collaboration from the bankers on the line, and Don and I would both like to thank you for the continued support of the benchmarking program. And with that, we'll take a moment to see if there's any questions from the audience.
We'll put everybody on mute just for a minute to take a look at the questions. So it looks like we don't have any questions today, so thank you everyone for joining us, and we look forward to your participation next time.